We have come to the, we are coming to the end of the Milken Institute Asia Summit 2015. I hope all of you will agree with me that it has been a wonderful 2 days. And thank you. Well, thank you for that. What I'd like to do now is to do one of the things that I enjoy and I consider most important, and that is to thank and ask you to join me in thanking the incredibly hardworking Milken Institute staff. My colleagues here in the Asia Center have done an incredible job in setting the table, ably assisted by our colleagues from the United States. It's been a great, hardworking team who have pulled this off virtually flawlessly. And I'd like to ask you to join me in thanking each and all of them for their incredible hard work and their efforts. Based upon what we see as the success of this event, I've got no doubt that we'll be having another Asia Summit next year, and we would welcome any comments that you may have, thoughts, any suggestions for improvements or ideas for next year. Please feel free to give them to Laura, to Petra, to any of us. We'd love to know any thoughts you have, and if you have any criticisms, hopefully constructive, we're happy to have them as well. So with that, let's move on to our final panel. This will be a great one. I hope you'll enjoy it. I also hope, by the way, I neglected to say it, but I do hope that many of you will be able to join us at other Milken Institute events, including, of course, our global conference, which will be May 1st, 2nd, 3rd, and 4th next year in Los Angeles. And if you happen to be in London on October 12th and 13th, and assuming that we still have space, or in California, or rather in New York in November for Partnering for Cures, or California in December for Annual California Summit, or in Washington on March 1st for our very first Global Health Summit, let us know. Okay, let's move on. We're delighted to moderate the panel on global capital markets, taking stock of recent developments. Martin Sung, who is the CNBC anchor, one of the network's founding anchors. He's been a leader in business television in Asia for more than 20 years, covering a host of stories, including financial crisis, ASEAN summits, post-conflict zones such as East Timor, and conducting scores of interviews with top business leaders, including Bill Gates, Jeff Immelt of GE, and ExxonMobil's Rex Tillerson. So please join me in welcoming Martin and our closing panel.
Ladies and gentlemen, good afternoon. Thank you for joining us or rejoining us if you are. First things first, I just want to make sure that the folks at the back, even though it's kind of a small ballroom, can hear. Is everybody okay? Just a thumbs up from the back. We're good? Fantastic, good. So we've got about 75 minutes to spend with you. The first 60, we're going to talk among ourselves, and then the last half, or the last bit, 15 minutes or so, we'll open it up to the floor, and if you want to weigh in or ask our guests your questions, please feel free, all right? I have to say, when I was asked to moderate this panel, I was kind of nervous, right? These guys here on stage with me, these are icons, these are giants in PE, and of course the man himself here next to me. So I'm honored and flattered, but also a bit nervous here. But I hope it's going to be a good session. These people really need no introduction, but just for protocol's sake, starting on my right here, David Bonderman, of course, TPG, Josh Harris, Apollo, Mike Milken, of course, and Michael Kim from MBK. And I did a little bit of back of the cocktail napkin math and added up AUMs. And I came up with a number of around $470 to $480 billion, right? And then I Googled and figured, oh my God, this is like the GDP of could be Singapore or Switzerland or Sweden. So this is an enormous amount of firepower on stage, and I don't know whether it's a security risk or not. But
I believe we added a decimal point to that figure.
okay, all right. So it's a heck of a lot of firepower, and backing the views that we're going to be hearing this afternoon. What I'd like to start off with, of course, is I guess we called it an icebreaker question, and let's not start with Mike, right? Because he's asked to sort of take a step back and let these gentlemen have a talk, and start with David instead. So, David, you've lived through, of course, several cycles or episodes of the kind of turmoil that we've been seeing. This one, though, right now, how is that different for you, if it is at all?
Well, the more things change, the more they stay the same, or maybe it's the vice versa here. I think you have to ask yourself, what crisis? This is, in my way of thinking, certainly not what happened the last time Asia around the late 90s, for example. The volatility of currencies, of course, important, but if you look beyond that, we have a situation where, from the perspective of what we do, which is invest as opposed to follow economies, economies, what's happening is not all that bad. The Chinese stock market, and China is what drives this region. The Chinese stock market, everybody says, it's down 60%, it's down 50%, it's down 70%, whatever it is, but people forget that it was up 268% in the 6 months before that, that the markets have outperformed the Western markets after the so-called bubble burst. Is China having to readjust? Yes, I'm sure we'll have a lot of chance to talk about it. I don't want to monopolize the conversation here.
Sure.
Is China having to invest? Is it going to be slower growth? All those things are issues, but they're not cataclysmic. This is not the end of the world. You will see, I think, increasing stability over time, and the volatility will continue to some extent,
Okay.
but it ain't the end of the world.
Ain't the end of the world, Josh?
If you take a step back, pretty much every country other than the U.S. is quantitatively easing. There's just a wall of money hitting the world right now, and growth is not great, but it's 2.5% to 3%. And the reality is that China has a lot of levers to pull to get itself I think structurally China's growth rate will come down, but I think China has enough levers to manage that, and I think it will manage it. And so I would sort of also say this isn't a crisis at all. If anything, security valuations are frothy. And so certainly there was a lot of leverage driving the Chinese stock market. The U.S. stock market is above its average P and EBITDA level. Rates are near zero. And so all the quantitative easing is sort of mispricing some of the risk out there. And so the fact that there was a little volatility, I think may even be a healthy thing for the economy by and large. Now, the one thing I will say is you've now got, we call it increased tail risk. So when you look at China's pullback, it shouldn't really derail what is a relatively slow growing economic expansion. But when you see the U.S. stock market go down 12% in 4 days, what that can do is start to create some negative momentum in the eyes of consumers, in the eyes of businesses, if that continues. And so there is a little bit of a possibility of a self-fulfilling prophecy where you get large moves down in securities pricing, and then that impacts people's willingness to spend. Certainly in the U.S., a little bit less in China because it's not as important. Or you get a big pop in real estate prices that were at a bubble anyway, but then consumers stop spending and businesses stop investing. So you got to worry about that. And the other thing you have to worry about is, if there is a hard landing in China, while it's only 13% of global GDP, it is somewhere between, depending on how you define it, 35 to 50% of global growth. It's driving that amount of growth. So if there were a hard landing or harder landing, and the Chinese authorities didn't manage it, it could take you down 100 basis points in the global growth rate. And I think that's what I think the U.S. markets were reacting to, because it's hard to make sense of it otherwise. The U.S. imports from China, or exports to China, are de minimis. So it wouldn't make sense otherwise. So I think there's increased tail risk, but by and large, I think we're still on the base case is still, mid to high twos in growth rate, low interest rates, relatively stable, growing world economy. China going from 7 to 6 over time. That's still the base case, but you just now have to worry a little bit more.
Okay, all right. Michael Kim.
The center of gravity of the global economy is clearly shifted to Asia, and China is at the center of it. So I think it's entirely appropriate to be focused and, to a certain extent, concerned about the recent events in China. But first, China is fine. I think the stock market has decoupled from the real economy. The economy is growing 6 to 7%. More importantly, the domestic consumption is growing still at 10%, double-digit growth. And that, in our view, is going to be the driver of China's economy. So China will be fine. The second point I would make, though, is Asia is not monolithic, nor does Asia equal China. There are other economies. People tend to forget Japan is the third largest economy and had been the second largest for 2 decades. And for me, the impact that China's recent turmoil and I think we'll get to currency issues later, but the renminbi devaluation, the impact and the second order impact of that kind of devaluation on the neighboring Asian economies is going to be a key story to follow in the future.
Indeed. Mike Milken.
I have a couple different views, I think, on the subject. One, if you're in the West, defined as Western Europe and the U.S., you're reading stories every day in those newspapers about the Middle East, refugees moving into Europe. It's potentially destabilizing the United States, and it is destabilizing in Europe as to what you're going to do. When you see China devalue your currency, when you thought it was only going to appreciate, it's the next thing that you can't count on that any longer. Third, in the emerging markets, the drop in the price of natural resources and other issues that drove their economies, they're going to have to adjust their economies. So if the price of energy alone, an ore is down $2 trillion, how is that going to flow through these economies? And so I think what's happened is people are looking for a strong platform to stand on. To me, if China can grow at 6%, I would say that'd be an amazing. I think that might be optimistic. 5% for a $10 trillion economy is pretty significant growth from that standpoint. So I think what's happened is there's uncertainty in different parts of the world. And people are reading different newspapers for the for the Brazils or Colombias of the world. The drop in natural resources and other things is the major factor. And so I think people are looking for stability. On the other side, liquidity has never been stronger. So the question is, where are you going to invest? The percentage of the net worth of individuals in America in cash has doubled since 2007. So the financial crisis in 2007 has made people much more concerned about their liquidity, and so that liquidity exists. In terms of corporations, not just U.S. companies, but companies throughout the world also went through a crisis in 2008, 2009. Their liquidity has never been higher. We look at Apple today at over $200 billion. A company has over $200 billion in cash. They had $15 billion in cash in 2007. The largest companies in Japan, to follow up on Michael's statement today, 40% of the GDP in Japan lies in the cash sitting in Japanese companies. So the companies have liquidity, individuals have liquidity as we've never seen before. And so I think it's the uncertainty. But the real challenge ultimately is for the investor. Where can you get an adequate rate of return or a return to meet what you think your actual assumptions are or your objectives? And for the three people running private equity firms, what rate of returns can they achieve in this environment in a zero interest rate? So to me, it's not at all like it was in previous crises. Liquidity is high, and it's just a combination of different things that are affecting different parts of the world today. The question is, what can you count on? If you can't count on the Chinese currency appreciating anymore, if you can't count on the price of iron ore, oil, natural gas, agricultural products, cotton, you name it, what can you count on?
So, which leads to an
Luckily, we
interesting...
can count on you, Martin, and CNBC.
Well, okay. What can we count on in terms of, let's say, in terms of topicality and timeliness, right? The Fed, what it did or rather did not do overnight. Did that surprise you, David Bonderman?
No, I've been saying for some time I thought the Fed would do nothing.
Okay.
Because if you look at what's going on in the U.S. economy, it is essentially the background of a regime that does nothing. I mean, we're in a situation where the U.S. is growing moderately well, maybe even a little better than people have expected. But as Michael pointed out, there's lots of uncertainty everywhere else. And this is not a time where the Fed is going to look to destabilize anything. Now, the truth of the matter is probably a small rate increase wouldn't matter. The numbers over the last 50 years show you that if the base rate is 5% or less, a small increase in rates is typically favored by the market because it's sort of a sign that the markets are doing well. Well, outside the U.S. and maybe a tinge in Europe, they ain't doing so well, as Michael pointed out. So it's a good time to think about what you're going to do. And to Michael's question of what you can count on, first of all, there's nothing you can ever count on, or we'd all be at the track with the daily racing form and putting, $6 down on American Pharaoh. I mean, life is uncertain. It continues to be uncertain. There are periods where there's sort of more global stability, but it always ends badly. It has every other time, and it will again, but it isn't going to happen now.
Josh, how long do you think we can count on rates staying low for longer?
Yeah, I think it's going to be quite a while, unfortunately, for returns. It's going to be quite a while. I think if you look at it, the EC has just recently come out and said they're going to continue their program of quantitative easing for a long period of time. You've got Japan and economics. You've got now China, protecting their currency and using dollars to buy renminbi. And so really, quantitative easing works. It worked in the U.S. Everyone saw it work in the U.S. And so where the U.S. expanded its balance sheet, $4 or $5 trillion, but now the world's picking it right up. And it's interesting. The U.S. may go the other way, but it's sort of, to a large extent, it's now lost a little bit of control over its own rates and its own ability to do that. One of the reasons why I think the Fed didn't move, and I agree with David, it wouldn't have made sense to move, is what's gonna happen to the dollar, if the Fed starts raising rates precipitously or aggressively or even in a minor way. They didn't want to take that chance. So I think that you're going to see it's going to be lower. If you look at all the curves, the Bund today, the 10-year Bund, it correlates 95% with the U.S. Treasury. It's 100 basis points. So even if the Fed wanted to get rates up, it wouldn't be able to. I don't think. There's a huge arbitrage that would exist. So I think for better or for worse, for us as investors, you're in a zero-rate environment for a long period of time. I think that's going to rule the day. I really believe, notwithstanding, Mike's concerns and tail risk and everything else, and instability, the governments have shown the willingness to plow as much money as they have to into the system to actually keep things on track. And I think that may be negative in the long run, but in the medium run, it's likely to keep things, on track, slowly growing, rates near zero, and that's going to pull all returns down a bit. And so, as investors, we have to be, super creative to get to invest the capital in ways that are wise and create alpha in this kind of world.
Okay, uncorrelated returns. I mean, for you PE guys, right? It's like, what people should be looking for more is risk-adjusted returns, I think would be fair to say, right? So, I was doing a little bit
So
of reading.
one
Yeah.
comment there, Josh, I was not saying we shouldn't invest due to risk. What I was saying was really much different. It's the psychology in the short run as to how people react. So you've been reading about refugees in Syria and stuff for 3 to 4 years. What you didn't realize was it could come home. Okay, whether it's Syrian refugees coming to the United States or going to Europe, that the world is so small today that these things come home and how you're going to adjust to them. But I do think the overriding factor, we talk a lot about risk, but the overriding factor is what is the risk of not investing today? And in a zero interest rate environment for those people that have to achieve some rate of return, whether you're a university endowment, whether you're a family office, whether you're a foundation, whether you're a pension fund, insurance company, you are forced to figure out what are you going to invest in here today. And it's only so long you can invest in things that are yielding zero because it puts pressure on the environment. So this volatility gives people an opportunity to invest from that standpoint. And I think, as Josh said, everyone that's bet on interest rates going up has lost and it's been carried out. And I would say to you, in 50 years of looking at financial markets, I have not met anyone who has significant net worth who can tell you where interest rates are going. Okay, so they might have been right once, they might have been right twice, but it doesn't work. And so isn't this what the central bankers want us to do? They're forcing you to invest today and figure out where to put your risk-adjusted capital.
In the U.S., we say don't fight the Fed, but I guess globally, don't fight the central banks. I think if you fight the central banks, you're likely to be wrong. And so it's really about figuring out those arbitrages in the world that, for whatever reason, exist. Financial services in Europe, where they're deleveraging, where the banks are just so large that they need to sell assets at discounts, even though there's this wall of money. There's so much supply of assets that there's an arbitrage, you can get a good return. U.S. energy, we can debate. I think the energy markets could be getting interesting at this point. But there's a relatively small number of arbitrages, and the goal today is to try to find them in this wall of money that is sort of overvaluing every financial asset that exists.
So let me ask you, Josh, where do you see opportunities then?
Well, I mean, just to continue thematically, I'd say the biggest opportunity we see is the deleveraging of the banking system. So the banking system, notwithstanding, the only thing bigger than the central bank's balance sheets is the banking system. So the banking system is over $100 trillion globally. It's 41 to 45 billion in Europe. It's It's 15 trillion in the U.S. and the balance all over the rest of the world. So it's 100 trillion. So when the banks need to get smaller, which they do certainly in Europe, and they have some problems obviously in Asia, in China, they sell large packages of assets. They sell businesses. Being in a zero-rate environment as a bank is tough. Certainly, or as an insurance company, or as a financial investor is tough. You get your deposits are cheap, but guess what? You have nowhere to put your money. So the spread goes down, and so there's a lot of pressure. In Europe, the Swiss banks are multiples the size of Switzerland. So if you're Switzerland, you want the banks to get smaller. You're not really that interested in them remaining that size. And so, there's an opportunity in the credit sector globally to fill the gap where the banks are exiting, and there's an arbitrage.
So I'm glad you brought that up. I mean, as an example, because we sat down and talked to the folks at BNP and also CS, right? And CS, the CEO, about 2.5 months into the job, a lot of people, everybody's watching him to see how he's going to reshape the bank, including cutting the fat and where, right? UBS has been through something similar. They did it when there's this search for yield and rates were almost guaranteed to be lower, right? And people were worried that for CS under Tidjane Thiam, might be a little bit harder if rates are on the rise to dispose of stuff that they are likely to be selling, prime brokerage or their fixed income or whatever else. Now that the Fed has come out and said, okay, look, and people are guessing, okay, probably December, maybe next year, who knows, right? But rates are going to be low for longer. Does that make his job easier, one, and does that make his assets more attractive to people like you?
Yeah, it makes his job easier and our job harder.
Okay.
What it does is, when the monetary authorities come out and provide, liquidity, which is in essence what you're saying, or don't take liquidity out of the market, which is the opposite, it takes the pressure off the banks, and therefore, yeah, they're going to get higher prices. There's likely to be more competition, and so really, in our business, it's about when you're in this world of beta, right, where it's very difficult to find alpha, it's about innovation. It's about finding those things that are more complicated that other people might not have figured out just yet. The non-performing loan space in Europe, is and was like that. It was really uncompetitive. It's getting a little bit more competitive now, and you have to keep changing, the types of assets you're looking at and so forth, and in essence, ratcheting up the complexity to stay ahead of the curve. But yeah, certainly in an easy money environment, when the EC announced its big quantitative easing program, guess what? The banks do slow down a little bit. The pressure's off. So I think it is positive for CS from that point of view.
Okay.
So
Sorry,
I
David.
think we're talking about an issue that is partially relevant but not fully relevant to the business we're in, which, as Michael says, is providing capital. We're in the deal business. The rates can go up, the rates can come down. What we're looking for is a niche somewhere, as Josh says, where there's an arbitrage which is in your favor, and it may be very localized. It may be that there's some particular view on Vietnam, which is detached from the actual investment opportunities, because people hate Vietnam for some reason. There's an election coming up, and the prime minister and the vice prime minister are fighting with each other. And so you have an opportunity, not because the world is going one direction or another direction, but because there is a micro opportunity. We bought an airline or two in our day. Terrible business. But if you buy at the right time from the right people, it comes out all right. We make 10 times our money in 3 years.
Sorry.
No, Michael Kim has done the same thing repeatedly in Korea. So in the scheme of things, we're in the deal business. We are looking for a deal. And yes, is it relevant what Credit Suisse is doing? Absolutely. Is it relevant what Stanley Fischer, who learned a lesson in Israel when he was head of the central bank there, that you can't raise rates as the central bank and have it work necessarily? You need cooperation from other parts of the economy. Do we take all those things into account? As best we can. But at the end of the day, we're looking for an arbitrage. We're looking for a deal. And it doesn't have to be a huge one. It just has to be enough to satisfy what our...
All right, do you see opportunity in Vietnam for some of these niche deals?
Absolutely.
You do? Okay. All right, Michael, go ahead.
Where the price arbitrage exists is here. You asked the question, what can we count on? Amidst all this volatility and market turmoil, what you can count on is Asia being the engine of growth for the global economy. And the answer is demographics. I think there was a chart or map, one of the slides that shows the map of Asia.
The one that, you mean where half the people in the world
Half the
in this little
people
area?
live in this little
This
circle.
is a stunning chart, yeah. If you can bring it up.
It's
Anyway,
coming.
Yeah. Go ahead, Michael.
Demographics is the engine of history, and this map, this will tell you where the global economy is headed. You're talking in the markets that I cover and invest in, North Asia, China, Japan, Korea. Those represent the numbers 2, 3, and 13 largest GDPs in the world. As goes North Asia, will go the rest of the global economy. On Josh's point about price arbitrage, the great thing about China, and this is why it's the promised land for private equity folks like us, there are still great pricing inefficiencies. We just bought a logistics business for about 7.5 times EBITDA in an industry where the comps trade at around 14 times. That kind of price arbitrage is very difficult to find in any other market in the world. It was hard to do. It took a year to do, and a lot of Mao Tai drinking to convince the owner to reinvest with us, to sell to us and reinvest with us. But it's worth it if you can get it at half the multiple, half the valuation that comps trade at. So those pricing inefficiencies exist right here in Asia, and they exist in China in greater numbers than anywhere else. And that's why you invest in China and in Asia today.
Michael must be fundraising, but I'm just kidding. I actually, it's interesting how you can look at two things and look at them diametrically oppositely, because truthfully, I actually think I think when you look at the Asian P markets and the Asian credit markets, they're, relative to the size of the Asian economy, they're much smaller. And there probably is an opportunity there. I think there's some structural challenges today for alternatives firms in investing in the region, relative to transparency of financial statements, relative to culture where it's maybe hard to get control. I think the valuations are much higher. So just as a global investor, and we're actually over here really trying to figure it out and expanding our presence here. We continue to think from a risk return standpoint, relative to our strengths and what we're doing, that it's going to be a smaller part of our business. We're here. We're looking to expand, and I don't mean, and then I think so I think look, let's face it, like right now I think you're in an environment. I think one thing you can count on it right now is the U.S. economy. U.S. economy is actually chugging along. It's between 20 and 25% of the world. So I think you got to kind of be broad and have a broad view of the world, and it's like and look up and down the balance sheet anywhere in the world, and there'll be days where Asia and China are interesting. There'll be days and opportunities where U.S. and Europe are interesting, and I think you want to have a broad vision of it all and be comparing across all regions from a risk return standpoint. I think right now, I think there's a lot of volatility in Asia. Not that I think it's a bad long-run growth.
I'll take that bait, and I can
Okay,
afford
go for
to do
it.
this. 'Cause I've been doing this with Josh for 25 years. Back from
We're
our
in the same
business school
class
days.
at Harvard.
This U.S.-centric view of the world, and particularly viewpoint of Asia, it's fine. U.S. is the center of the world, but it suffers three problems. It's false, it's immoral, and it's dangerous.
Okay, this is where it
You're
gets
going
interesting.
to invest in
Okay.
Asia.
Michael, Kim, go for it. Yeah.
We have a saying in Asia, the arm bends inward, meaning locals like dealing with other people who are like themselves. So I think to be really committed to the market in Asia and to be successful, you have to be either local or fully localized. That's the only way you're going to get entrepreneurs and CEOs to join forces with you and sell control. I agree with Josh. Control is a difficult and rare commodity to get in Asia, but you got to do it by investing in the relationship over the long term. And the only way you do it is by becoming local.
So let me just weigh in
Just to
for
make
1 second.
Michael,
You go first, David. Then.
Michael and Josh are both half right.
Okay.
What I mean by that is, if you're talking about the private equity business, buying control, buying companies, Michael Kim is surely right. You have to be localized, which is why the successful pan-European, pan-Asian, pan-global firms all have Chinese in China and Vietnamese in Vietnam and Indonesians in Indonesia. You have to be. If you're in a trading business and a debt business, like where Josh's firm predominantly has been, you don't care about those things. You've got a bunch of bloodless traders across the aisle who will never care whether they ever see each other again, and will probably cut off some body part for another nickel. Meanwhile,
Wow.
Michael Kim,
Getting rough up here.
That's brutal. That's brutal. Yeah.
and while that's happening, Michael Kim is out drinking Mao Tai for a year, trying to get somebody to persuade him to do a deal, where Josh is doing it every 14 seconds. Depends on what business you're in. Both models can work, and they can both be wrong, and there's pros and cons. Michael Kim is surely right about the population being in Asia. On the other hand, China is going to start losing people because of the one-child policy, and the demographics will be much less attractive when the population begins to shrink. So there's always pros and cons, and which is why I say these two guys, who are among the best investors anywhere, are both half right.
Okay, fair enough.
Someday they'll both be
I
all
think
right.
I'd like to go back, if I could, to a point Josh was making. I think it's an underlying point here. And what I had said at the very beginning, Michael has really focused on. People know their own area best, and I think that's what David said. And people that are successful investors invest in areas where they have expertise. People that are unsuccessful investors venture into areas they don't have expertise in. And so one of the areas Josh talked about that I just want to pick up on is the financial service industry. So the banks in the United States are relatively small today as a part of the economy, and they really are not the driving financiers of the economy. They serve as intermediaries for the most part, and they own less than 15 or 16% of bank loans. As Josh pointed out, the three largest, say, French banks are the same size as the three largest U.S. banks, but the U.S. economy is 8 times or so bigger than France. So these countries run the risk because the banks are too large relative to the size. Next, the countries run the risk, and all the companies, because the financing of those countries is dependent on the strength of a handful of financial institutions. And what the United States has done, and Europe is in the process of attempting to do, is separate so that the public and private markets finance the countries, the businesses, et cetera. And this is a significant challenge in the future for Asia, because Asia is still bank-centric. And so most of the money in China is deposited in a handful of banks. Who they decide to lend money to or not lend money to will determine part of the growth of the economy. And so the potential for the movement of these financial assets from the banks, shrinking the size of the banks, into money managers, other institutional holders, can change the course of history, create jobs, et cetera. The second area that Michael was driving at here, that there's a solution to this problem, and that is today you can have an app on your iPad or your device that allows you to read newspapers from all over the world. And that's really what I was starting at in my initial conversations. If I'm in Europe, I'm reading newspapers about refugees and other things that are occurring. If I'm in the United States, I'm reading similar issues. If I'm in Indonesia or Malaysia, I'm reading about the volatility, and I feel it every day of my currency and what's occurring. And if I'm in Australia, I'm really concerned about the price of iron ore and what's happened to natural resources. And the same in Brazil. So in order to succeed, you need to read local newspapers. We don't need to read what's going on in Korea reported in the United States. We need to read a Korean newspaper as to what's important in Korea. And they're all different elements today. And so what's important to an individual economy is different depending where you are in the world today. And to be a great investor, you have to think globally, but you have to invest locally, I think, is the point. Now, Apollo, and Josh is pointing out, they're looking at an opportunity in one of the world's largest markets, $100 trillion market, that needs to sell 20 or 30 or 40 trillion of it. What role is Apollo or TPG or others going to play in buying those assets today? And if they get in their hands non-bank banks, they'll be much more aggressive lenders, and they'll spur the world's economy from that standpoint.
To pick up on what Mike's saying, I think if you think about the size of the Asian economy, it's a little bit bigger than the U.S. economy. It's about 20 or 30% bigger. China is 60% of the U.S. economy. When you look at the middle part of the capital structure, the sort of credit markets, if you will, they're a fraction the size of the U.S. market. So there's a real opportunity here in Asia for firms like Apollo, firms like TPG and others to step into that middle part of the capital structure and provide growth capital that might be that's debt, that's mezzanine, that's high yield, if you will, and help develop those markets. In order to do that, the region does, the financial statements and some of the other, the creditor rights, some of the corruption issues need to be managed, and I think are being managed. I think Asia is becoming a really interesting place to play. It's still, and so it's one of the, as we think about how we can play a constructive role in Asia, it's probably the odd private equity transaction that Michael's doing, the odd one, the idiosyncratic one, but much more so it's being a solution for capital structure and for facilitating where the banks might not want to play.
It's kind of amazing to think how Asia has grown, how successful it's been without access to modern capital structures. Yeah. And so if it had modern capital structures in Asia, and who's going to play that role, whether it's going to be Western banks. We talk a lot about technology in these digital devices. What we don't talk as much about is the knowledge of financial technology, of how you'd finance the building of infrastructure and all these type of things and apply it. And if we had that same access to financial technology and systems today in Asia as we do in the United States, it'd be amazing what would happen to the growth from that standpoint. I just want to come back on one other area, Martin, and that is we talk about a lot of things, but ultimately at least 50% or more of the growth, and in the case of Asia, probably 60 or 70% of the growth is just accountable to one factor: longer, healthier lives. I just think we can't really step back. It's so unbelievable, a 70% increase in life expectancy in Southeast Asia in 2 generations. Okay, the 4 million previous years of human evolution didn't take us very far, but a 70% increase. And so people are going to be healthier. Today, and Josh is now in this business with the purchase of all the life insurance companies, but the probability of a 72-year-old man dying in the United States in the next year is the same as it was for a 55-year-old man dying in 1975. So in 50 years, you've moved here 17 years. And so yes, China is aging dramatically. We're just not sure everyone's going to be retiring at 60 or 65 or 70 any longer. And so one of the centers at the Milken Institute is the Center for the Future of Aging. And as you improve the quality and length of a person's life, what are they going to be doing the last third of their life? If their last third is 60 to 90, where before you were focused on them calling it a day, quote, at 60, what role are they going to play in society? Are they going to be working? Are they going to be consuming? What is going to happen in that area? And I know we had a number of people at the global conference this year in Asia and at the global conference who are focused on elder care in Asia. So if you start thinking about industries and businesses, there are certain things we know, and that the senior population in Asia, just like it's the largest in other areas, it's going to be the largest in the world.
So just to pick up on Mike's point, going back to what can you count on? One thing you can count on is that every human being wants more and better health care and is willing to have themselves, their family, or their government spend to do it. And it has nothing to do with the rest of the business cycle. It has to do with how people's feeling about their health care systems. And so if you look at areas that are worth prospecting in, healthcare is surely one of them. That's true everywhere in the world, and it's certainly true in Asia. And just one other comment. Michael was talking about banks. Banks play a different role in society in the emerging markets than they do in the developed markets. They are much more important, and we have found in Asia that has been a niche that you've had the opportunities where the bigger guys are withdrawing because of their problems in the first world and leaving wide open vacancies. We own banks in 8 different Asian countries, including Korea, and they've all been successful. not because we were brilliant, but because they're a societal need.
I agree on the banks, and to tie it back to Josh's earlier point about the middle part of the capital structure being an opportunity in Asia, I couldn't agree more. Debt capital in Asia has just been misallocated over the years. And that's because banks in Asia, I don't want to offend anyone, but banks in Asia are dumb. It's a burden of history. Banks grew up in Asia by making policy loans. If you think about Singapore, Hong Kong, Taiwan, Korea, the old Asian tigers, they grew in the 70s and became developed countries by becoming export machines. And those export machines were supported by policy loans from the banks, private and public. And so you have this history of allocating debt capital for policy reasons, and that's been a legacy. And I think that's really one of the factors that precipitated the great Asia financial crisis. David went in and bought acquired and turned around the 6th largest bank in Korea at the time, Korea First Bank. We did the 7th largest bank, and it was alarming what we found. The credit committee, when we asked them, why did you lend this amount of money to this negative EBIT earning affiliate of some group, their answer was because it's the X group, because it's Daewoo. Well, we all know what happened to Daewoo. So those days are behind us. If there's one good takeaway from the Asia financial crisis, it's that the banks in the major Asian economies that were adversely affected, they were recapitalized, and I think they turned around by becoming, for lack of a better term, more Americanized.
When is that going to happen to Chinese banks, do you think, Michael?
That's a different
Animal.
bucket of issues.
Oh, yeah.
Because of one problem, which is lack of transparency. Nobody who looks at bank balance sheets in China believes they're NPLs. Nobody. And that's been the case for the last 10 years, maybe more. One of the key things to China's upgrading to the next level as a global economy is they're going to have to get better transparency, better consistency in their financial disclosures. Now, until we get that, we won't have a sense of the whole. Until you have a sense of the whole, you just don't have an accurate sense of the health of the banking system in China.
You know, it's interesting, Martin. When I've visited with students in graduate schools and finance in China, I've been impressed with their sophistication and knowledge of the history and their sophistication of capital structures. Many of them have gone to school, either undergrad or graduate school, and as Michael did, in the United States or Europe. So I think there's significant talent in China, inside the country, that if they had the freedom to attack many of these issues, they would be successful. It is unusual, but it is really the history that it takes someone like Michael and his firm to turn around a bank in Korea, or David has addressed many banks in Asia. But I think there's a lot of talent today, and there's a lot of lessons to be learned, and it's not just Japan or parts of Asia that have ineffectively allocated assets. The United States has greatly misallocated assets to residential housing. So we have tremendously overbuilt residential housing, both in number and in size, and diverted assets that should have gone to maybe medical research or healthcare or particularly education. So there's a lot of lessons to be learned. I think my feeling is it's very hard for change. I think the people in China today are fully aware of what went wrong in Japan, where you had a handful of banks control the entire banking system. Now, whether they can go from point A to point B is very hard. If you're in a group of 10 and you have the market, do you really want to bring in outsiders to share the market with, even though it would be beneficial? But I think ultimately these things changed. I think the Asian financial crisis, as Michael pointed out, has caused change. But at the moment, Asia is still dominated by a banking financial system.
Well, it's not a banking financial system because you have some relatively free markets. When we and Michael made our mutual investments in Korea First and his bank, we fought with the government every single day for 5 years because they wanted us to do this, they wanted us to do that. Michael went through the same thing, I'm sure, and they were always wrong. But being it was a kind of quasi-democratic place, you ultimately worked it out. If you buy a bank in China, which we did, you're an arm of the state. Whether you're privately owned or you're not privately owned, you're an arm of the state, which is why the NPL situation that Michael referred to is so lacking in transparency, because you don't really know who's behind which. Well, one thing you know is that the central bank will tell you every year what your banking portfolio is going to look like and whether you're going to loosen your policies or you're not going to loosen your policies in ways that in other countries it doesn't happen. So these markets are all idiosyncratic. They all take a sort of special skill to deal with.
Josh, go ahead.
I was just going to say, I mean, and one of the ways you deal with it is, in India, there also are really difficult structural challenges for non-bank players. And, rather than go it alone, you team up. We JV'd with ICICI, the largest bank in India, and our success before that JV with special situations lending was not so good. Because the laws, the regulations, the red tape, if you will, which is it comes from tape around an Indian court case. That's literally where the word comes from. Would just delayed our ability to, as a creditor, collect. But then once we were with the bank, we were picking the right borrowers. They were much more. They were reputable. Banks themselves have a lot more power, and so, one approach to the markets here is to customize around, different solutions for different geographies. People talk about Asia being a uniform place. It's not. It's multiple jurisdictions. Each one is, as David said, idiosyncratic, and you have to take a special approach to everything.
So you know what? While I've been listening to you guys, we've been talking about China, 1.3 billion people, aging, graying, workforce is shrinking, we know that. But, I had a thought. There is also, we're talking about a new generation of younger Asians, right? Very tech savvy, et cetera. And I'm wondering whether firms like Michael's, we're talking 10 billion, right? You corrected me, I thought it was 8, right? Have a slight advantage here and could sort of get over some of these structural impediments and cultural ones that Josh has been talking about, right? Because they're much more, I'd say, open to the rest of the world, more possibly Western educated, et cetera. And these are the guys in board shorts, riding bicycles who could be on to the next big thing, but they need capital. So you guys are middle part of the capital structure, right? But I'm thinking, how much opportunity do you see, Michael, lower down, smaller check sizes with these kinds of guys who may be more, well, let's say, easier to work with?
I mean, clearly, I mentioned before that Asia is getting Americanized, for better or for worse. People at our firm don't bicycle to work in their shorts, but I think that wave is coming. And Michael mentioned it in passing earlier, but one of the great exports of America today is education. With the notable exception of Japan, almost every Asian country sends its best and brightest to the West, and notably to the US, for either undergrad or, more often is the case, for graduate school education. So they get inculcated in them, not just the value, not just how to, they learn not only how to run an Excel spreadsheet and do DCF analysis, but they get inculcated in them the values of a liberal democracy and a US-style capitalist system. And they bring it back, or we bring it back. And as that evolution happens, I think Asia becomes more innovative, it becomes more adaptable to change, and it becomes more connected to the West. So I think that creates opportunities. I said Japan is a notable exception. I'm a big fan of Japan. I mean, everything works. We talked about transparency. Everything China does not have, Japan has. You go to the Shinkansen in Kyoto, and the train's supposed to stop at 101. It stops at 101. Everything works. The only thing that doesn't is Japan's insularity. It's the one Asian country that has not been outward looking, in my view, and has not sent its young, its best and brightest to the West. So I think it's become a little bit insular, and in my view, it's the most conservative society on earth. You're talking about a country that's been ruled by one party or one coalition of parties for the better part of 50 years. So it has utter stability, but it has not been innovative to the extent that its talent would warrant.
I think there's an interesting point there, Michael, when you talk about what you have gotten from the West. Everyone on this panel has gone to graduate school in the United States. And one of the things you do learn is regression analysis. Now, what's regression analysis? It tells you the future bears some relationship to the past, and you attempt to project. And I think this is a potential weakness that has to be adjusted. Asia is going to be substantially different in the future than it has been in the past. The past, we had this amazing increase in life expectancy, increase in generations, people rising up. The future will be stable to decreasing populations, but a huge middle class population. The rise in the middle class in Asia, and a wealthier group. So you're going to have a whole generation that grew up wealthier. Whether they have the same desires, the same get up and go, time will tell, because they won't have been born into as much of a struggle as the previous generations who had lived through World War II and a massive struggle, and then dramatic changes in China, Vietnam, and other places. And so will they have the same desires? Will they have the same goals? In the next generation, next 20 or 30 years, time will tell. And as Michael pointed out, yes, there's a lot of good things, but unfortunately, the United States and the West has been exporting our junk food to Asia. Therefore, levels of obesity are going up, other disease issues have come, and we see, for example, in China, as much as a 5-fold increase in hormone-driven cancers in the eastern part of China, where the diet has changed substantially in the last decade or two. And so the incidence is substantially higher than in Western China. So you get both good and bad movement here. But I think overall, as Michael pointed out, the liberal democracy change, a willingness to accept new ideas, is a significant change in Asia. And I see it as another potential growth element for Asia, the access to more modern financial technology, which should allow more aggressive investment and more expansion.
I do want to clarify my position. I stated strongly that Asia is getting Americanized, and that's for the most part a good thing, especially as it relates to the markets. That's not to say that Asia is becoming America. I don't think that's desirable. I think Asia, the beauty of Asia is that it's holding on to its, not decades, but millennia of history and culture, even as its political and economic systems are getting modernized. And I think that combination is what makes Asia unique, and I think that has to continue for the future. The late senior minister, Lee Kuan Yew here, he was famous for saying that Asia needs to develop our own Asian form of democracy, that it can't be just a US-style or UK-style democracy, but that we have to adopt elements of the Western model and change it, evolve it to fit Asian culture and our moray. And I think the same for the markets. I think we have to develop our Asian form of capitalism. That means a little bit, an element of central planning, Ministry of Finance in Japan or Korea. I think it means different kind of structural reform. I also think it means a stronger element of egalitarianism. You can't have layoffs in Korea.
So for point counterpoint, I would say the most valuable thing we see, the culture of Asia, is a commitment to the education of your children. And the sheer fact that the second largest expenditure by the middle class in 11 Asian countries is for education. 15% of their income, obviously Korea the highest in the world. And so this belief is what has drawn the Milken Institute and myself to Asia over the past few decades, in that education is a consumer product in Asia. It is not a consumer product in the United States. And unfortunately, in the K-12 area, only 2% of the income in the middle class is spent on education. And so this is a quality that is very important in Asia and has differentiated Asia from the United States at the K-12 level, whereas the U.S. has the leading post-secondary education. The other thing that, Michael's happening is the fastest growing ethnic group in the United States are people of Asian ancestry, growing at over 20%. And so who knows? It won't be long before the United States is Asian itself.
All right, a real specific point. You know, one thing that a lot of people are wondering is, with regards to the renminbi, right, and the devaluation, where it's headed, what China's real intentions are. David, do you have any thoughts on that?
Well, the answer is sort of.
Sort of, okay.
As Michael pointed out, nobody's made a living predicting where currencies are going. And nobody's made a good living predicting what central banks will do. But I think if were forced to make a wager, I don't think you're going to see the Chinese devaluing again for a long time. I think they think this was a mistake. And I think that what you're going to see is the renminbi will start strengthening again as we get through this little period of time.
Why do you think that?
Why? Because basically things aren't so bad, as Michael Kim said. You know, maybe it's 5% growth instead of 7% growth going forward, but they're pretty astute at managing the economy. They've got a lot of levers to pull. They've got lots of reserves, and they will do something about it. You can see from his speeches, President Xi has some things in mind. Chairman Xi has some things in mind.
And that's going to stop the capital outflows?
I think they're going to have to go with the markets here. And at the end of the day, I'm not saying there's no dislocation, but at the end of the day, basically, if you look at the Chinese economy, it will be strengthening over time, and so will the renminbi.
You think so, Josh?
Yeah, I think there's some short-run pressures on the renminbi. They have a lot of reserves to deal with that. Whether it's, whether they slightly depreciate it or leave it the same. I don't have a view on that, but I think that they're going to use up a bunch of reserves defending it in the short run.
Okay, and they've got money to spare.
There'll be capital. I think they have to, regain the confidence that I guess Mike was talking about them having lost. And I think, but my guess is they're pretty committed to leaving the renminbi relatively stable against the dollar. I think right now, it's really going to come down to, the dollar, I think, is going to strengthen. The only thing I would say in the short run, and a lot of the longer run trends, are hard to disagree with. If the U.S. starts to get wage inflation and starts to tighten, there will be a big run at the renminbi, and because they'll be going the other way, and similar to many other currencies. So the question is, how much firepower are they prepared to use to stem the capital flows? So I think long run, I agree with David. Short to medium term, to deal with the current monetary policy issues, you would think it would go the other way, other than their commitment to stabilize.
I worry about another additional devaluing of the renminbi. I worry about the impact on the Japanese, the Bank of Japan and their policymakers. I think they'll have no choice but to devalue the yen further. And then the knock-on effect on Korea, that's what I'm worried about even more. Korea competes against Japan almost head-to-head in every major export category. Steel, automobiles, semiconductors, consumer electronics. Korea has to devalue. Then you have a currency war.
Michael, any thoughts?
I think the currency challenges are different depending on which country you're talking about. So the countries in the Middle East, particularly Saudi Arabia and Abu Dhabi, et cetera, that just kept them in a peg to the dollar. So the strength of the dollar has strengthened their currencies. If you're talking about a country like Colombia that's seen its currency drop substantially, Mexico, Brazil, et cetera, they have been in an indirect currency war already, or Russia. And so my view is that the challenge from China, in my opinion, is from within, not from without. Do the individuals that have accumulated enormous wealth in China want to diversify their holdings and hold some of their assets in another currency, whether it's the Sing dollar, the US dollar, whatever it might be? And so the wealth that's been created is so significant and so broad in China. I think it's a question of asset diversification. The strength of real estate in Miami and other parts of the United States has come from Latin America or Europe, et cetera, that wanted to diversify their assets from that standpoint. So I don't really see the RMB being weak except for the desire of people within China for asset allocation. And I think the story of 2015 has not really been the story of volatility of markets. It's been the volatility of currencies and the enormous change. Now, part of that has been due to the enormous change in the value of energy in US dollars by others adjusting accordingly. But I think that risk and that volatility is going to play more into investors. And so when TPG or Apollo, are you in Korean currency measured, your performance, or US dollars?
No, US dollars.
So we have 3 people whose performance is measured in US dollars. So they have to factor in their investments in different parts of the world, factor in what's going to happen to the currency as it relates to their total performance. And I think that is somewhat the story of 2015, is the unbelievable volatility in currencies for countries with very large economies.
For the first time ever, we're hedging, we're hedging currency outside the U.S. dollar. So if you have a U.S. dollar fund and you're making investments in, Australia, China, even Europe, you really have to hedge because you can do great and lose it all on currency.
Get killed on the currency, yeah.
And like I said, I think we really just next 1 to 4 years, U.S. raising rates, everyone lowering rates. There'll be lots of pushback against the renminbi. Mike's point also, there'll be pushback against the renminbi. And you're going to have, the government going the other way. And that's, who wins that? Unclear.
Okay. All right, we've got time to take a couple of questions from the floor, if anybody's interested. The gentleman right there, please, in the glasses. Sir?
Thank you, Martin. I just feel like want to make a point here because one surprise to me. Well, first I'm Larry Zhang from CI's China Invest Corp. From China, and the one surprise to me was how many China was mentioned in this conference, and it looks like a bigger issue, but it's not necessary. It's a field in China. So it's maybe you think it's a China issue, but it's really your problem. All right. Second is I do want to talk about the Chinese economy. It's not aim to really help Caterpillar or Australia. It's an aim to help the Chinese economy to grow, to help people's well-being and happiness. So it's all of a suddenly become like, seems like a Chinese problem. It was all point to China put for the slowdown, but it's really China shifting the gear from the infrastructure built to well-being of a human, of their people. So it's like you build a house, you buy steel, concrete, but you build already. China have built the first-class infrastructure in the world. If you go travel, you can feel it. Now China just need to buy more furniture, rugs. So it's a shifting gear, and you see the Apple doing extremely well, Samsung doing extremely well. So it's just shifting to consumer. It's transitioning itself from a manufacturer-driven society to a more mature consumer-driven. So that offer the opportunity to the rest of the world, just for different guy. And what's the reason paying $100 for iron ore? It's just earth sticking out from earth, just lucky to be in Australia. So why are you paying more? So I think people should realize what's the value of those earths. China, you call it a slowdown, but I don't view it's enhance its life quality, enhance its consumption. The measure of GDP growth, I think it's stupid, but I couldn't believe that people in this house all believe of GDP growth, because it's all about the GDP quality, not of the raw growth of GDP. Because if someone point out that we dig a hole and fill the hole, it's still counted twice of GDP, right? So what's the point? And I want to comment on the gentleman from TBG about the population of China getting aging. But I would say what world was worried about China getting too many people. Maybe 20 years ago, or maybe 30 years ago. That's the reason why I have the one-child policy, and I think it's good for the country. Good for the country because that's whether the country can support it, the earth can support it. I don't think it's the purpose. I'm not sure, Michael. Maybe you have points, but what's the purpose for the population? Is the goal for us, for the human being, to pursue the maximum number of the population, or is the goal to pursue the wellness of the existing population?
Okay, Larry, thank you. Is there somebody in particular you'd like to respond?
Well, I just wanted to follow up on that.
Okay, go ahead, Mike.
I think this was the point that I was trying to make on the future is going to be different than the past. The rise of the middle class in China. You don't need it. It's not the number of people, it's the quality of life and what they're going to be focused on. So you can see today that, I actually believe China is going to become a leader in the environmental effort to increase the quality for their people. It's going to become a leader in electric cars. It's going to become a leader in a number of areas. And so it's a much different population in the next 20 years in efforts. And I think that's what you've outlined here. You're going to be focused on a consumer. You're going to be very focused on health care for the people. And if you remember the slides, I had put up these slides the other day showing you that in the bioscience area, China has increased its investment more than any other country in the world at this time. And so part of the byproduct of that investment in bioscience is the quality of life. And I think, as David pointed out here, there's going to be a lot of opportunities to invest in industries related to health and wellness, improving the quality of life in China. And I think that was the point that I was trying to bring out. What occurred in the past 1 or 2 generations is not going to be the focus in the next couple of generations. As the country is wealthier, The people are wealthier and are focused on quality of life, whether it's environment, health, etc. That would be my response to that comment.
Okay, folks, talk about red lights blinking. I think we need to end the session there. Thank you so much for sitting around and joining us. I'd like to thank our panelists, Michael Kim, Michael Milken, of course, Josh Harris, David Bonderman, and thank you for joining us.